You spent 30 years investing in building wealth, but here's a question no one has actually stopped and asked. Do you know what your portfolio is actually made of? Not the names on the statement, not the tickers, not who manages it, but the underlying value of everything you've built is actually constructed from. Most people can't answer that. Nobody has ever stopped to explain that the stock market has quietly transformed over the last half century into something that's fundamentally different from what it used to be. Today I'm going to explain what changed, why it happened, and why it matters right now more than it has in a very long time. This is part one of a three-part series. I'm John Cervantes. This is a practitioner's brief. Let me give you a number. 92%. According to the 2025 Intangible Asset Market Value Study released by Ocean Tomo, 92% of the S&P 500 market value today is intangible. Software, brands, algorithms, intellectual property, copyrights, data. Things by definition with no physical substance whatsoever. Now let me give you the number that puts that into context. In 1975, that number was 17%. The other 83% of the market was tied to physical assets, factories, machinery, land, buildings, equipment, things you could see, touch, and verify with your own eyes. So read that again. In 50 years, we went from 83% physical to 8% physical. The market of prior generations looks nothing like the one we have today. To understand this, you have to go back to the structural shift in the US economy itself. This wasn't an accident. It was a natural result of an economy that moved decisively away from manufacturing and towards services and knowledge. Services now account for roughly 70% of US GDP. We stopped making things at scale and started selling ideas, software, and expertise instead. And from a pure business model perspective, that transition makes a lot of sense. Physical assets are expensive. They wear out. They require maintenance and replacement and upkeep. And if you ignore them, they become liabilities. PG&E, the California utility, failed to modernize its aging infrastructure and was held liable for billions of dollars in damages tied to wildfires caused by deteriorating power lines. Physical neglect has a price, and it's not cheap. Intangible assets, they don't rust, they don't require a maintenance crew, and the economies of scaling them are unlike anything the business world had ever seen before. The purest expression of this is software. A software business at its best is a capitalist dream. You build the product and then you sell it a million times. Even better, you build it once and you charge every user a monthly subscription. Each additional cell runs at essentially zero marginal cost. No more additional raw materials, no factory floor, no shipping logistics, just operational leverage. Mark Andreessen saw exactly where this was going in 2011 when he wrote his now famous piece arguing that software was eating the world. His thesis was that more and more major industries would be disrupted by software companies, with Silicon Valley doing most of that disrupting. And he was right in just about every way. Look at the companies that have come to define the modern market and you'll see this pattern over and over. Google Search, arguably the greatest asset-light business ever built. Each additional search costs essentially nothing to run. The asset is the algorithm. Microsoft, a software licensing and subscription empire sold to a massive install base, with development costs spread across millions of users. The marginal cost of the next license is nearly zero. Salesforce pioneered the subscription model, add a seat, add recurring revenue with almost no marginal servicing cost. The more customers, the more the economics improve. And then there's NVIDIA, which is the most interesting example because most people think of it as a hardware company. NVIDIA runs what's called a fabless model. It designs the world's most sought-after chips, but owns none of the factories that actually manufacture them. Taiwan Semiconductor and others own foundries. NVIDIA's value lives entirely in its intellectual property, its software ecosystem, and its engineering. No multi-billion-dollar plants to run, to ensure, or maintain. And this thinking has spread well beyond technology. Home builders started controlling lots through option contracts rather than holding the land on their balance sheet. Retailers sold their real estate and leased it back to improve their books. Major hotel groups moved to franchise and management contracts rather than owning the underlying properties. Airlines lease aircraft. Even consumers have been pulled into the model. We lease our cars, we subscribe to our music, our movies, our books. The World Economic Forum's Klaus Schwab captured this trajectory bluntly. You'll own nothing and be happy. Wall Street loves it. Fewer physical assets meant companies could grow without massive capital expenditures. More free cash flow flowed back into the businesses, or it flowed back to shareholders via share buybacks. Asset light became the defining investment religion of the 2010s. And the data backs up why. Technology stocks have outperformed the broader S&P 500 for a generation. No matter how you want to measure it, relative to other sectors and relative to the rest of the world, the trade has worked extremely well. US equities have lapped global equities. The Magnificent Seven didn't just participate in the market rally, they've become the market. And at their peak, 7 companies represent over 30% of the entire S&P 500 by market weight. Now, is this irrational? Is the market crazy? No. The market was pricing exactly what it got. Superior earnings growth, expanding margins, and the compounding advantages of a business that scales without proportional cost. That trade made sense given the environment that created it, an environment of falling interest rates, expanding globalization, and unchallenged software dominance. That environment is now under pressure in ways that weren't true 5 years ago. Here's what I want you to sit with before the next video in the series. The S&P 500 today is 92% built on things that have no physical form. That worked extraordinarily well in the era that created it. But COVID exposed something important. The supply chains that looked lean and efficient turned out to be brittle. Critical materials are now flowing through choke points nobody thought twice about. The fragility of the asset-light economy is on full display. And now the very technology that validated the asset-light thesis, artificial intelligence, is forcing companies that built that thesis to spend hundreds of billions of dollars on the most physical infrastructure imaginable. Data centers and power. The largest companies in the world are becoming asset-heavy to compete. At the same time, AI is directly threatening the moats of legacy software businesses that defined the era. If AI can replicate the function of software at a fraction of the cost, what's left? There are no physical assets to fall back on. The regime is shifting, and most investors haven't. In the next video, I'm going to show exactly where the pressure is coming from, what it means for businesses that dominate the market today, and why this is the most important conversation retirees should be having right now. The link to the full written post is in the description. It has the data, the charts, and everything laid out in detail. I'm John Cervantes. This is a Practitioner's Brief. We'll catch you next time.